Because Investment Boost exists, and then we're coming up to 31 March, it's not a license to go, oh yeah, you know what, I'm going to go out and buy that Ford Ranger.
The misunderstanding is that buying that asset, it depreciates, and it starts depreciating from that day that you buy it, but the depreciation is the expense. That decreases your profit, and therefore the tax you have to pay. The full cost of that vehicle is not a write-off, is not a tax-deductible expense that brings your profit down. If you're looking for a surefire way to decrease your tax bill before the 31st of March 2026, we might have it, and it doesn't involve paying us via becoming a client. We're going to give away the secret of how to decrease your tax in 2026. Phil.
Mate, if ever there was a hook to get somebody to listen to our podcast, this is the one. Top tax-saving tips from the top accounting and advisory firm in the country. Investment Boost. It's quite a neat little wee product, if we want to call it that, or policy, but I don't know if people are aware, and I mentioned to you, did you ever get the link from IRD? Late last year, there was a survey request, and the questions were very specific about, do you know about it? And if you do know about it, how did you find out about it? And have you used it? And do you intend to use it? And it's just like, yeah, you guys are fishing for some information because the uptake and publicity of it hasn't been probably as big as the fanfare that went with the release back in whenever it was as part of Budget 2025.
Yeah, I thought we could step through a few misunderstandings of tax in general and then give people a bit of clarity about what they could be thinking about with Investment Boost before the end of the financial year. Because one of the things that we often hear as we get close to the end of the financial year is, oh, hey guys, I'm looking at buying a vehicle to decrease my tax bill. And I'm going to do it by, the end of March. It's around the 20th. I don't have much time. And the misunderstanding is that buying that asset, it depreciates. And it starts depreciating from that day that you buy it, but the depreciation is the expense. That decreases your profit, and therefore the tax you have to pay. The full cost of that vehicle is not a write-off, is not a tax-deductible expense that brings your profit down.
No, spot on. And I think, if anything, it probably does one or two things. Distracts your thinking and mindset because it's like, oh, Ford have got the latest deal on a Ford Ranger, and gee, the finance terms are looking pretty good. And you're not considering your cash flow. It's just like, oh, I think I can save tax, so I'll go and buy this car, pay a deposit. It's just like, yeah, I haven't saved any tax. So it's a little bit misleading, folks.
Yeah, I think the combos start going around the pub as well, right? Where it's misunderstanding. Oh, my accountant said that, if you do buy this vehicle before the end of the year, you are going to save all this tax. But where I think it's going to get even more confusing now is that you kind of can make an argument that buying a large asset, whatever it is, but if it's brand new or available new to New Zealand, is that the correct terminology?
I think so. And I was just going to loop back there for a moment, Luke, and say, have you ever overheard any of those conversations while you're sipping on a margarita at that rooftop bar at the bottom of town?
More familiar with the tax chats in the sauna. I heard the other day that if you move your crypto to a MasterCard sort of payment provider, that there's absolutely no way that the ID could ever track that you're spending it, so therefore you don't actually have to pay any tax on any gains on your crypto. I was like, I'm not volunteering into this convo that I am an accountant.
No.
Yeah, I was like, oh, that's interesting, mate. Yeah, okay. Yeah, good luck with that one.
So what did you volunteer? You're a builder or a plumber and you're just missing the Ranger?
Oh, I said I was a model, actually. Yeah, full-time, actually. Yeah.
What, hand model, feet model?
Look, listen, for some audiences online, just feet only.
Okay.
And for some in-person audiences, I can be asked to do a number of different things, Phil, let's just say.
Yes.
And I do have boundaries around that, okay, for anyone listening.
I'm pleased that you've got boundaries. But coming back to Investment Boost, this is the one hack, and I think where people are always going on about, oh, there's loopholes and there's advantages for the big corporates and the rich and all of that, da-da-da-da-da. No, there's not, and that's probably a podcast for another topic, potentially. But coming up to 31 March, you can get a tax deduction in this financial year for 20% of the purchase price, provided it meets the criteria, which you mentioned was it's brand new or new into New Zealand. And I think that that's a great little wee windfall. Not like you'd experience many of those from the TAB, but from the tax department, you can get right up to March and go, you know what, I'm going to buy this car and I'm going to save 20%.
Yeah, much like the increase in the low value asset threshold back in the COVID days, where we were making podcasts saying, hey, buy these assets that are less than $5,000 if you're going to be buying them this year and you can afford to. There's some keywords there, isn't there?
There's a classic thing there, if you're going to. So I think because Investment Boost exists and then we're coming up to 31 March, it's not a license to go, oh yeah, you know what, I'm going to go out and buy that Ford Ranger. I had no plans of buying a Ford Ranger. Or in the case of, you've got your hands and feet studio thing going on. It's like, you know what, I need a new camera because I need to take some higher definition pictures. I'm still taking some pretty good content, but I'll just go out and spend it. No. I think if it's planned, and this is a really good example. I was at a meeting with a client earlier this week, and they said to me, Phil, we need to buy a new ute. And I was just like, righto, well, what are we looking at buying here, guys? A Toyota Hilux. I was like, whoa.
Were they joking?
I was just like, are you guys sober? Like, are you feeling okay? And like, legit, Toyota Hilux. And they're like, well, we've got this option of either buying brand new pre-31 March or brand new after 31 March. And there was a minimal price difference. Some of the features and the colours were different. And I was just like, well, if you buy it pre-31 March, we claim the GST, the 20% investment boost, it's like, this is how much tax you're going to save. And on the Hilux, they're obviously not as expensive as a Ranger. The tax benefit was $3,000 that they would have to save, that they wouldn't have to pay provisional tax or terminal tax, whatever it is, of $3,000 in that year because they're going to get a 20% deduction of the cost price excluding GST. And when I said that to them, they're like, oh yeah, that's better than nothing. That's quite good.
Yeah.
And I was just like, okay, I thought $3,000 wasn't that much to move the needle. So I was just like, yep, so go away. And then the discussion evolved like, well, how are you going to pay for it? And that's the natural question that we always ask. And this particular client was, oh, we'll just, pay a bit in cash. And I'm like, are you sure about that? And knowing what we know about this particular client and their balance sheet and current trading position, it's like, you might want to get a loan for that and just pay it off over the next 3 years. Quite comfortable, but preserve the cash you've got. And they're like, top tip, Phil, thanks for that. And they're like, oh, before you go, we're probably looking at buying some more equipment. I was just like, tell me more. And they said, oh, we're potentially looking at maybe $30,000 to $50,000 of some equipment. I'm like, is it brand new or second hand? And they're like, it's brand new, Phil. I'm like, well, you've committed or you've made the mental decision to go, yes, we need the equipment. Pull the trigger and do it now before 31 March. You're going to get the tax advantage.
Nice. And that's the piece that I think people need to understand, where basically the 20% tax deduction, it creates a tax deductible expense. Because I think I had a client today saying, oh, I thought I get 20% of it back. No. So to illustrate, if you brought $50,000 worth of equipment on the 20th of March and it was brand new and it was eligible for investment boost, then you're going to have a $10,000 expense there and then on that day, which is 20% of that 50, which is going to end up in that financial tax year and bring your profit down and therefore the tax you have to pay. So then the remainder of the asset, the $40,000, is going to depreciate over the useful life of that, where if we didn't have these investment boost rules, then the $50,000 would be depreciating across the useful life of the asset. So all that you're doing is bringing forward some of the depreciation and expensing it faster. But if timed well in the back end of a financial year, then yes, it will decrease your profit and therefore your tax you have to pay. So hence why we say, if you need to purchase it.
I think that's a really good example with some simple maths for me to understand. And that's the trap that a lot of people think is going, okay, I'm buying an asset for 50 grand, 20% of that's 10. You're not getting $10,000 from the government. Like, let's be really crystal clear about that. This is an on-paper expense that accountants create. It's not a $10,000 check that you're going to get from the government to say, hey, you've gone and spent some money. Here's 10 grand. Thank you very much. Because a lot of people will be going out and buying a whole heap of stuff that they potentially don't need if they were getting money back from the government. And I think the next example for that, that flows on from that, with the additional $10,000 that's advanced. So what we're saying is it's timing of depreciation. We're saying the asset cost $50,000, and rather than depreciating that at $10,000 a year over 5 years, we're going to get $10,000 up front, and then the $40,000 is then going to go over the 5 years. The tax benefit of that $10,000 that you could potentially get at 31 March, at the company tax rate, let's assume at 28%, $2,800 on 10 grand. So then is it really worth it? Like, you're going to all of this effort of going, shit, I've got to go through these hoops and deal with some punishing Ford dealer. I've got to go and deal with some punishing banker to arrange finance. Finance company's got to provide the last 3 years' financials. They're going to need a forecast just to save almost $3,000.
Yeah, I nearly fell in the trap, mate, and I haven't let you know him, but I was nearly about to buy a G-Wagon in bright orange to do some marketing for Next Advisory. So
Naughty.
it was $500,000 when I was there. So I thought, well, with misinformation number one, oh, great, we get 100 grand of that off because 20% of 500 is 100K. They were like, no, that's not how it works. So what would happen there would be that $100,000 would be a tax expense in our 2026 year. And because Phil and I are in the top tax bracket, then we would save ourselves $39,000 of tax that we wouldn't need to pay than if we had have brought that on the 1st of April and I roll around in my orange G-Wagon. But I decided not to do it, mate.
Oh, mate, I was actually looking forward to a $40,000 tax saving that we could go, we've got the cash because we're very prudent about how we plan for cash, and then we'd go and put that into Bitcoin.
Wow. face some real risk with that. I don't know, it would be more risky buying the orange bloody thing with me driving it and what the rims would cost on a G-Wagon.
Are you thinking about buying a business or maybe getting yours values? At Next Advisory, we help you figure out what a business is really worth and guide you through a business purchase with confidence. Before you buy, visit nextadvisory.nz and book a time to have a chat with me.
The other thing that I heard around this that I thought may surprise you, mate, is that someone said to me, oh, we're going to buy brand new because you don't get GST back with a second-hand vehicle. And I thought, okay, but there is a bit of information floating around that you can't claim the GST back on a second-hand vehicle, and it seems to be popping up. We didn't used to hear this, but over the last maybe say 6 months, I've probably had 3 people say to me,
Seriously?
oh, I didn't think we could claim the GST on that because it's not brand new.
So where that's come from?
Yeah, but I mean, get your own advice from your accountant, but you would find that most accountants would be advising you to claim the GST on second-hand assets that you are buying privately, that you are using in your business, and there are some rules that are going to support that around keeping the details of where you purchased it from, what date, what was the address, who was the seller, what was the amount.
Spot on.
So, don't let that get in your way.
The last time I read the GST Act, there is a provision in there for second-hand goods claims, and you can claim the GST potentially from an unregistered person, but you do need to seek professional advice.
As always. And even with this, I think, go and speak to your accountant so that you're not misinterpreting what we're saying. And like Phil said before, how are you going to pay for it? So make sure it's fit for purpose with your business, that you're not going to then run into a cash flow hole, or even you're seeing marketing from car dealers or equipment dealers saying, right, because I think some of them will be going, okay, we've got a lower interest rate up until this date, and it coincides with investment boost as well, but really the lower interest rate is funded by an increase in the purchase price of the brand new asset. But it's very easy to overlook all of that when you're hearing, oh, sheesh, low interest rate by 31 March, oh, great, and also investment boost, that's saving you tax, and you're going, oh, sweet, I might as well just get on with it, I'm running out of time, the deadline's coming, I'll purchase it.
Yeah, and I think with some of these spending decisions, it's pretty easy to get some emotion caught up in the decision and going in it with rose-tinted glasses, particularly when it's the old Ford Ranger, because you've got to have the latest and greatest.
No, grey one.
Yeah, when you're rocking up to the old local placemakers and you've got all your Makita gear in the back, and you've got the boat because it's a Friday, you're not doing any work. Weather's good, we're going out for a fish. That emotion can get tied up in these decisions. That's where I think you really need to, and emotion can override and distract from making a decision quickly. And that's where I would really stress okay, if you're going to do this, how are you going to pay for it? And once we're clear about how we're going to pay for it, what is the impact that it's going to have on your business and cash flow? Because you're having to generate income on the profit and loss, pay tax on that income, and then with that after-tax income, use that cash to pay the debt. It's not going into your back pocket. So are you going to be comfortable that an extra, I don't know, however many thousands of dollars a month that's going to be in loan repayments, that's going to come out of your cash flow?
Nice.
And I'll go on to say, to help you come up with the answer to that, are you confident enough that your pipeline is robust enough for the next 6, 12 months that you can make this purchase today. And I fucking bet you that if we had a room of 100 business owners, there would probably only be a small handful of hands that would go up and go, yeah, I've got confidence in my pipeline.
Yeah, especially, do you track it? No. So
Spot on.
Go back and listen to the pipeline podcast we did. It is funny, though, when you say that, actually. It's a very good point that people will back themselves to pay back the loan somehow. Oh, she'll be right. I will make it work. But don't take the same thinking towards, okay, well, what does your pipeline look like? Oh, they actually don't know, and they do worry about that, but they don't then worry about loan payments as long as I have the Ranger or the whatever it is. So, yeah, interesting.
I wonder when we're going to get the letter from Ford to stop mugging off their products.
Well, actually, I was going to say before that, and I think I mentioned this to you in the office, that someone said to me recently, they recognised when they're talking to me, and I had accountant, blah, blah, oh, yeah, you guys do all the work with the tradies, eh? And I thought, not necessarily. And I thought, shit, I wonder if that's because we're always mugging off Rangers.
Probably,
That the perception is. But anyway, it is quite funny now when a client of any industry gets in touch and they're like, lads, I've brought a Ranger.
And every time I see one on the motorway and I go past a Ford dealership, I look at them and have a little chuckle to myself.
Yeah, and sometimes then they say, P.S., but if you drove a Tesla, you dick. So I'm like, hey, that's fair enough.
Fair call.
What are you doing mugging me off? I wrote down these 3 questions, mate. If you're thinking about a purchase, ask yourself, as you've so well touched on, number 3 was, can the business comfortably fund it, cash flow / finance, without creating stress? And number 1 and 2 are, would I buy this if there were no tax incentive? Could be a good little filter question.
Oh, that's naughty.
Yeah. And number 2, does it clearly improve productivity or profitability? And this is with vehicles. This is something we see a lot where it's, I'm buying this because I know my other one's going to have heaps of repairs. And it can be a bit of a doom loop that business owners, trick themselves into or get into because they are trying to play the game of, decreasing repairs or timing it to the perfect. But I don't actually know if that's even possible.
I've just had a thought. If you're looking at buying something in March because it's just like, oh, I'm going to get an expense deduction for it, the question I would ask, why haven't you done it sooner?
Great question.
Like, if you've known you've needed a new Ford Ranger or a piece of equipment, but you're thinking somehow miraculously there's some benefits for year end, why haven't you made the decision sooner? Yeah, I just come into my mind. I think that's something for people to think about.
And so for those who genuinely do need to buy new equipment, I think this is a perfect time to be thinking about it before 31 March, but understand these tax rules before you pull the trigger and understand what level of finance you're signing yourself up to or what level of cash you're going to then have disappear out of your bank account.
You got that quote for those new batteries on the Tesla?
Not yet. Yeah, it'll be coming on the 28th of March. Yeah, that's it for me, mate. I think that's as simple as it needs to be.
Yeah, mate. It's not a hard one. I think if for anyone that's tuned into this one, if you've got any questions, get in touch with your accountant.